Good morning to our participants in Europe, and hello to those who are here in Asia. I'm very happy that we have today our policy dialogue that focuses on Europe and China and the macroeconomic development and outlook. Part of what we're trying to do is to provide data-driven information on these large jurisdictions, but also encourage a dialogue between Europe and China. I'm Alfred Schipke, the director of the East Asian Institute here at the National University of Singapore, and I'm joined by my colleagues and friends. Let me first start with Moritz Schularick, who is the president of the Kiel Institute for the World Economy. He's also a professor of economics at Sciences Po in Paris.
Hello. Thanks for having me.
Then my colleague and friend Huang Yiping, who is the dean at the National School of Development at Peking University and is also a professor at Peking University. In addition to that, he's a member of the Monetary Policy Board of China's Central Bank, the PBC. And last not least, again, colleague and friend Guokai. He is the executive director of the CF40 Institute. He's also a non-resident senior fellow here at the East Asian Institute, and he was a former DDG at the PBC in Beijing. So with that, I think what we're going to do is we're going to divide our presentations and discussions into two parts. We will first start out by discussing the European outlook and recent developments, and we'll then follow with a short Q&A session afterward before we move on to the China outlook and development. But with that, I'll pass along the baton to Moritz.
Well, thank you, Alfred, and thanks for organizing this. I'm very excited and honored to be here with Guokai and Wang Yiping and you, obviously discussing the macro structural outlook. So let me start by sharing my screen. That is the presentation that we have prepared. I hope you can see this really well. So the European outlook, let me sort of start with the year that has just passed and give you an idea where we stand. So Euro area growth last year was around 1.4%. That is in the face of the trade conflicts, probably a result that is more resilient, GDP growth at least more resilient than many had thought. The services sector was strong. Manufacturing started quite strong into the year, but then weakened towards the second half. For the coming years, we essentially think that Europe will remain in that range, which is sort of clearly below the growth rate of the US and the growth rate of China. But given Europe's demographic and productivity trends, probably in line somewhat with potential as we stand. The main story, and you see the key countries also, obviously UK is no longer in the Eurozone, but is a part of the broader European economy. For 26 and 27, the main story is a revival of German growth, is quite resilient French growth, and also in Italy. In the UK, we, as many others, are quite slightly more pessimistic than maybe other official forecast, with the inflation running high and the budget situation being as difficult as it is. Our key view here is that the UK will basically grow at 1%, so slightly below the European average. I mentioned the key story in Europe really is a revival of investment. That is partly linked to the AI boom. That is obviously also, so far has not been a big story in Europe, but is increasingly coming over here. Remember, there's a lot of talent, a lot of companies, a lot of startups, a lot of human capital that has been involved in that. Typically on the, going to the US, but increasingly we see activity also in Europe. The other second big story on the European side is the lifting of the German debt brake for defense and for infrastructure spending over the next years. So German investment, in particularly, is will increase quite significantly, both on the civil and on the defense side. The French economy, very much service driven. Has held up reasonably well last year and is supposed to remain decent in terms of overall growth outlook. But of course, here, as in other European countries, I'm sure we'll discuss this later, the fiscal outlook is something that's preventing higher growth rates. France has to bring down its budget deficit that's currently still running around 4 to 5% of GDP. If you go to inflation, this is for Europe, I think other than the investment revival, one of the bright spots. Inflation is really under control. It's probably in Germany even going to undershoot the 2% ECB target this year, 26, and even next year remain very close to target. In the countries with more fiscal tightening, I mentioned France, probably the undershoot is going to be even bigger. Our ECB forecast is as simple as it gets. Just take a 2% line and extend it into pretty much eternity. We don't see much change there over the next 2 years, certainly not this year. If anything, I guess, with geopolitical risks, with trade risks still weighted to the upside, if anything, likely the next move could be down, but we don't have a down move in here as long as we don't see any major shocks coming from the outside. So let me zoom in a little bit on Germany, which is the largest Eurozone European economy, as you know, and is really the economy where there's most of the action is taking place. What you see here is a composition of the German budget over the next 5 years or 4 years, starting 26, 27, 28, 29. You see there's quite some change there. These dark columns rise substantially. If you go from 24 to 29, it's essentially a quadrupling of defense expenditures reaching something like 150, 160 billion euros by the end of 29. This is not a forecast, by the way. This is in the budget planning. The budget law for 26 obviously has been passed, but there is a medium-term planning, and these numbers are not our numbers. These numbers are the official numbers. So, if you will, there's another big orange column that's the pension expenditure. Unfortunately, that's not coming down. So we are debating structural reforms on the social welfare system quite intensely here in Germany, but nothing has been agreed upon. If you look at the German budget going forward, it's really sort of a mix of a pretty generous welfare state with a growing military, growing defense budget. That brings me to the investment forecast. Again, Germany, I've seen this has been very weak, driven by the weak manufacturing, weakness in the car sector, weakness in other sectors. You see 23, 24, 25 were all down years for investment, minus 0.5, minus 5, minus 2 last year. Going forward, this is going to turn positive quite sharply. We have investment growth between 4 and 5% for both this year and next year. In the numbers driven by the change in the fiscal stance, overall, it's a change in the fiscal stance of about 2 percentage points of GDP. That will, together with some of the measures, investment measures aimed at allowing for more immediate depreciation, making investment more attractive, will bring some life back to the investment in Germany. And if you put these two main trends that I've told you together in in a sort of in a pot, and you stir it. And I think this is an economy, overall the European economy, that's been quite resilient last year. Now investment is reviving. There's a shift in the fiscal regime in the largest economy that, people have been talking a lot last year, then it's been slow to be implemented, but this year, next year, the change should be really visible. Plus a very benign inflation and interest rate outlook. So it's quite a supportive environment also from a market perspective, and you've seen European indices doing quite well. Obviously, now we've seen last year alone a 15% appreciation of the euro against the dollar. At some point, that will weigh on exports. But then we've had that with Switzerland and other countries. A lot of the European exports are quite specific and not as exchange rate sensitive as in other countries. So let me conclude on one big question that I throw out there for all of you. This is some of the academic studies for the essentially the fiscal multipliers for defense spending. And given that Europe is, just returned from Davos last week, the big question and the big topic is obviously a revival of European defense spending, a medium-term goal to shed the large dependence from the US. And as Europe takes so much money in hand to boost its defense sector and spends a lot of that money also on upgrading its facilities and high-tech areas and satellite constellations and autonomous systems, etc. The big question is, what will the growth impact of this defense spending be? I gave you the German case where defense spending quadruples, goes from less than 1% of GDP to more than 3% within 3 years. So if you put in 2 additional percent of GDP into defense investment, what's the growth impact of that? The chart here gives you the academic studies, I would say the serious academic studies that we have for the defense multiplier. And you see that's anywhere between 0.67 and 1.5. 1.5 is a US number that's maybe on the higher end, but probably around 1 is not, or slightly below 1 is not a totally unrealistic number if it's done right. So if the German and other European governments spend an additional, the plan is about $1 trillion of additional defense expenditures over the next 4 years, the GDP impact should be I don't know, maybe not quite $1 trillion, but around maybe 800, 900 billion. So I think it's on balance not a losing proposition to say that a significant part of that defense spending will be spent at home, will support the European investment recovery, and will provide a little bit of a balance to the overall challenging trends, of course, in the global economy, both on the trade side and with regard to competition from China and other countries. Let me leave it here. I think I've exhausted my 10 minutes, and I look forward to some of your questions.
Thank you very much, Moritz. Let me start out. I think you painted a relatively a positive scenario, which is basically the fiscal stimulus, in large part driven by defense. There are other areas where I think there is renewed effort, whether it's on AI, whether it's on semiconductor, whether it's on investments related to rare earth, subsidies for industrial policy. So that seems all very good. But I wonder a little bit about the monetary fiscal policy interaction in this. So on the one hand, what we see is that inflation is kind of normalizing. The ECB is relatively cautious from now onward, and based on I think your projections, there is not much need for additional changes in monetary policy. And so the heavy lifting is done now from a cyclical part as it relates to the fiscal, and you said it might have some positive implications. But given that in many of the European countries, the fiscal space is already very limited, or at least debt levels are very high, if you now do this push, that can, of course, lead to higher debt levels. It might lead to a greater diversion depending on where you are. And then ultimately, can that lead to like what we call fiscal dominance, which ultimately then kind of puts pressure on the ECB again, as in many other places. And how do you see that kind of developing? And do you share that concern?
Right. So I think it's important to look at the heterogeneity within the European economy. The largest economy, which is Germany, has fiscal space. So I don't think anyone is with public debt to GDP levels of something like 65% or so currently. No one is really worried about sustainability and or fiscal dominance. For the other countries, take France as the second largest economy in Europe, and Italy, clearly debt to GDP levels are very high, 120+%, and fiscal space is very limited. But for those countries, what we have in the numbers and what the policy plan is not increasing deficits. It's, if anything, bringing deficits down. Definitely that's a task for France, and one that's been, quite costly for two governments already in terms of finding the support for that in Parliament. The plan for those countries is to increase defense spending and increase investment spending while keeping overall deficits at least stable, or if not bringing them down. So we don't have any numbers, and I think anyone currently foresees fiscal debt finance expansion or increase in the deficits in the countries that have very little fiscal space. If that were to happen in a way that threatens sustainability of public finances, I think you're right. Worries about fiscal dominance and potentially even worries about sort of stability and intra-European divergence and spread levels widening again would be there. Right now, if you look at sort of market assessment of fiscal policy spreads within the Eurozone, there isn't much to really worry about. The fiscal expansion story is predominantly a German story. And here, let me make maybe two quick comments. There is one on the fiscal expansion. There's one risk, which is execution. Famously, the German government, the German state, is not very fast and not very efficient in getting the money down into the economy. That has to do with lengthy planning processes, with lots of participation rights. Everyone can say like, "Oh, I don't want the new rail line built here," and then it goes to courts and things take forever. So that's one risk. With the spirit of optimism that I'm trying to convey today, there have been some changes to regulation that allow the government to speed up these processes, essentially build the stuff and then wait for the courts to pass their judgment later so that these holdups are avoided. So that is maybe a reason to get a little bit more optimistic about execution this year. The other point is, and I haven't mentioned it because because we're talking about sort of the macro, the cyclical outlook, not as much about the structure. Obviously, there's big challenges that Europe has in terms of demography, in terms of regulation, in terms of, partly in terms of technology and business dynamism. I haven't mentioned that there's a potential upside that some of these structural reforms that are not so, in theory, not so complicated, right? I mean, we know what to do. If some of these bottlenecks get lifted, there might be another sort of more structural push that also then lifting the potential growth rate. Right now, us, like probably most people, are reasonably, let's call it sober, when it comes to assuming big structural reforms actually lifting European growth potential in the short run. Because a lot of the things that you would have to do to lift European growth potential are, you think about reforms to the social welfare system, pension reform, a smarter way to handle migration, clearly also cutting red tape, lowering taxes and getting business dynamism up to speed. All of this is, there's some low-hanging fruit. If you think about the Draghi report, the European agenda, basically finishing the internal market, building it for services, removing the internal barriers to trade within Europe. Some of these are low-hanging fruits, and I think we could get some progress on capital market union, etc. But some of the others, obviously, pension reforms are contentious everywhere and will take time. But Look, in expectation, and we're macroeconomists dealing basically in expectations, there's going to be some reforms coming on the structural side. How encompassing they're going to be is, I think, very hard to judge at this moment. There seems to be a little bit of a reform drive in Germany this year. People came back from the winter holidays or the holidays over the New Year and said, like, we have to do something, and there seems to be consensus on moving forward. But then, the devil is in the details. Let's see how far they get.
Before I pass it on to maybe Juan Yiping and Gurkai, maybe just we got two questions related to defense spending. One is related to the multiplier, whether the multiplier only relates to investment-related defense spending, R&D, but does it also include spending on personnel cost? That's one. And the other one is more, is there a potential for competition or collaboration with China?
Two excellent questions. Thank you. So on the first one, yes, you can break down the components of defense spending, and depending on whether you look at the short run cyclical multiplier or long run more sort of productivity growth multiplier, the composition of defense spending appears to matter a lot. There's a nice paper last year on the sort of the productivity effects of defense spending, especially of defense R&D spending. As you know, a lot of innovations in history have come from defense from the defense sector, and spillovers into the civil into the sort of non-military sector have been quite large at times. You think about internet, GPS, rocket technologies. All of this is originally defense technology. This time around, I do agree. The more R&D, you think about autonomous systems, you think about space constellations, think about advanced software, the better it will be for European productivity and technological capabilities going forward. And I've been making the point very strongly over the past year in Europe that what Europe needs to live in security and be able to defend herself over the next decade. When you think about autonomous systems, you think about satellite constellations, communications, intelligence abilities, you think about advanced software, you think about robotics, you think about hypersonic technologies. These are exactly the technologies where Europe has kind of fallen behind the US and China in the non-military sector, in the civil sector. So there is a confluence of factors coming together, and if Europe spends that money right, it could obviously also on the, if you think about military cloud and AI hyperscalers, that defense money could boost European technological capabilities quite a lot. It's not about human capital. A lot of that, a lot of the famous white paper on AI. I think 5 of the 8 authors were Europeans. So it's not about having the human sort of the understanding. It's about having the scale and to implement these things, and that could come from the military. If you think about personnel and sort of the low key, also like, tanks and stuff, I would agree the multipliers are probably lower, both in the short run and in the long run. And yeah, again, I've been also been quite vocal in trying to push a lot of that defense spending into the high tech areas. The second part, cooperation with China, I think it's very limited, to be honest. The defense sector in all the big countries tend to be quite national. I think you don't want to be in a situation where you have supply chains that depend largely on other countries that can cut you off at their liking. So, if anything, I think this will be if you want, the defense sector will be sort of the core of I don't want to say of a more European-based supply chain developing. And I'm sure we're going to discuss European-Chinese relations later on. I think there's one stumbling block, and that is Russia. Other than that, there's a lot of joint interest in keeping the world trading system what it is. But as long as we don't have a sort of a clearer sort of decoupling there between China and Russia, it will be very hard for Europe also to enter into closer defense cooperation. Look. Last word, after Davos, we've seen the European-Indian Free Trade Agreement this week. Clearly, there is a very strong drive on the European side. Also, with the sort of semi-success last week of pushing back Trump on Greenland, that a united Europe, which actually is one of the largest economies in the world, can play a much bigger role in world affairs, and for that it needs to diversify away from its dependence on, let's call it, a U.S. administration that is irrational and in some parts not aligned with European interests. And China, India are obvious candidates, but I think Russia right now stands between a much closer cooperation between the EU and China, and I think that's a pity. And I hope I hope there's a reconsideration of that support for for Moscow.
Maybe I could ask Juan Yiping and Gurkai to kind of both back to back ask you the question, and then maybe you could answer them together.
Maybe I'll go first because Moritz, well, first of all, I enjoyed your presentation. You almost answered the question I wanted to ask. That's the reapproaching between Europe and China, the implication of this. And in addition to benefiting both parties, and some people, including myself, are hoping that given the US policy at the moment, China and Europe might share some common interest or stake in sustaining the current international economic order. But you mentioned that there are barriers, including Russia. Are there any other barriers? But more importantly, what would you recommend for the two sides to do to support a sustainable, open international economic system?
Right. So, yeah.
Before you answer, maybe we can also add you Gurkais, and then you can do it in one swoop.
Very happy to.
Yeah, Moritz, very good. My question is really, Europeans need to do a lot, military, technology, some industrial policy on green technology. The only economy that seems to have a fiscal space is Germany. Is that enough? And do you need some European level of fiscal arrangement capacity, pan-European level of fiscal capacity that allow Europeans to do more rather than just rely on Germany's coffers alone? That's my question.
Fantastic. Thanks both for these incredibly insightful questions. They make me think, but I'll take them in the order they've been asked. So, leaving sort of the geopolitical constellations aside, I think there is a joint mutual interest in keeping an open, rules-based trading system. I think also in terms of future closer cooperation, there are our institute and myself among them. There is a growing, I think, a growing voice in Europe. If you think about EVs and battery technologies, to seek closer cooperation between Europe and China. And if I can say this sort of with a European hat on here, I don't think Europe will stand by seeing Chinese EV companies basically kill Europe, the European car industry. That will not happen. And if that is the threat, then Europe will put on tariffs. European governments will not stand by and see that happen. But there is a scenario in which essentially what happens in the EV sector is what happened before in the combustion engine sector, just with the signs reversed. So now this time, Europe invites Chinese producers to invest locally, to enter joint ventures with European producers, maybe to do technology transfer. And that will be the condition under which the large European market that, I think everyone in the world also depends on the car industry, will remain open to Chinese producers. And I can see if there's a genuine willingness to become economic citizens of, from on the side of Chinese EV companies and battery companies, produce locally in Europe, also have the value chains in Europe, including the battery manufacturing, etc. the way we have, integrated, I mean, 30 years ago, essentially Japanese producers into the European market. I think that could be, in a far-sighted policy, and also a very, very important step on the Chinese side to basically link the European and the Chinese economies in ways that they haven't been linked before, and alter a little bit the global picture there, because it's very clear, I think, that the US is not going to go down the road of EV vehicles, and having China and Europe basically being in one very large sort of integrated production market there would change a lot of sort of global industrial ways. So I'm quite hopeful on that. I'm not, there's a lot of talk about the second China shock in Europe now, like that essentially now the core of European and Northern European industry is in a heavy competition with Chinese manufacturers in the car space, but also in the machinery space and others. And I'm pretty sure if the answer is not a sort of mutual beneficial local investment FDI-based strategy from Chinese producers investing in Europe, setting up factories, maybe buying European companies like Volvo, it's been done 10 years ago or so. That is that's a scenario that makes me very hopeful, and I think that's in the mutual interest. It will not be possible, I think, that in the current export-driven Chinese model just continues for another 5 years without having a very harsh European response at some point. Guokai, on your question, yes, I think it's correct. Germany is about 1/3, a little bit more of the European economy. It's not the whole bunch. If you add in the Scandinavians, so the Swedes and Norway and the Danes and the Finns, so other countries, and maybe to some extent the Netherlands, countries with some more fiscal space, you maybe get to a little over half of the Eurozone that has the potential to expand fiscally. And these also tend to be the countries that, given the proximity to Ukraine, given their sort of the urgency that's felt much more strongly in Central and Northern and Eastern Europe to build up defenses than, say, Spain and Portugal. These are the countries that also want to invest more and jointly in defense. So I think potential is there. It's certainly the space to watch. It's even, I agree with you. The homework Europe has to do is enormous. But there's some green shoots, and if you, for example, look at some of the drones sector now, the autonomous vehicles that are developed in Ukraine and partly in cooperation with German companies, there's a lot of, it's probably the only area right now where Europe is the world's technological hotspot, and that's because of necessity. And I can see a lot of things growing out of there. New launch capacities now develop very fast for a space constellation. So, obviously it's not a done deal, but it's probably, if you want to paint a more positive picture, it's that the countries that have fiscal space are also the ones that are most invested and most convinced that the new global security situation, especially the situation in the US, warrants higher investment very quickly.
Thank you, Moritz. We have a lot more questions, but I think what we'll do is we'll move to the China part now, and then, of course, at the end, might pick up some of the questions again. And I think you kind of agreed to moderate the next section. So, Moritz, you are in charge.
Yes, well, it's a great honor to do this. Thank you, Alfred, for handing over. My job is to hand over to Guokai, and we're very much looking forward to your assessment of China's macroeconomic outlook, and then I hand over to Professor Huang Yiping for his words. And Alfred, you will be last, so we have a nice choreography built in. Thank you very much for enlightening us. And Guokai, the floor is yours. Thanks for being with us.
Okay, thank you. I'll talk about the recent developments and the outlook for 2026. I think if you want to describe what happened in China in 2025, I think resilience probably is the better word to describe it. The whole year growth was 5%. based on official data. And it was also the annual target set by the government. This year, China faced multiple shocks. We had this 20, 30 plus tariffs from US. The property sector continued to go down. And prices of a lot of stuff is also in negative territory. So the 5% growth was quite a robust growth number despite of those. And if you look at the growth trajectory, it was more front-loaded. So we have a pretty good Q1, and everything started to slow down since Q2. And gradually, every quarter growth rate started to moderate a little bit. The fourth quarter growth rate was 4.5%, but overall, the whole year was 5%. If you look at a bigger picture, the whole economy actually started to stabilize around Q3 of 2024 when the Chinese government did a major policy pivot. They start to do a massive fiscal stimulus program and debt resolution program to local governments. Starting from then, actually, the economy started to pretty well. And why we have a slowdown since Q2 this year, since Q2 2025? I think essentially the economy faced three shocks at the time. The first one was US tariffs. US tariffs didn't really show up in Chinese export data, which I'll talk about later. It's really created this kind of uncertainty that dampened confidence of the private sector. Then housing sector started to turn south again, and the private investment started to slow down since April. The uncertainty of tariffs actually created a lot of confidence issue, then slow down in activities. A second shock, was policy induced. China had this anti-involution campaign towards certain sectors. The policy alone, I think, was meant to make the supply and demand more balanced in certain sectors, which is good intention. But on the other hand, a necessary condition for that to happen actually is for those sectors to curb their investment and to slow down their production, which necessarily leads to some slowdown in those sectors. That's the second shock. A third shock is that despite a very, very, I think, accommodative fiscal policy in 2025, the profile of spending actually changed over time. It was more front-loaded, and that led to quite a strong start of the year. And over time, the spending slowed down a little bit, which leads to slower growth later in the year. Also, the composition of spending also changed a little bit over time. At the beginning, a lot of that was spent on things on investment and supporting consumption. And in the middle of the year, some of the spending was geared towards recapitalization of banks and resolution of local debt. I mean, those spendings didn't really translate directly into domestic demand. So that makes the slowdown of the fiscal felt more strongly in Q2 and Q3. In any case, I think those three shocks, I think, can explain a lot why the growth slowed down quite a bit over the course of the remaining quarters of 2025. But despite that, I think if you look at data, you probably would think China's fixed asset investment actually turned negative towards the end of the year, and consumption slowed down considerably towards the final quarter of the year. If you just take that at face value, you would think China's economy is slowing down considerably, which we don't think is the case. For consumption, because of this trading program started in late 2024, its impact is waning over the course of this year. That's why you see quite a dramatic slowdown of consumption. But if you strip those goods are not affected by this strip of the goods that is, you just look at the goods that is not affected by this trading program. Actually, consumption was quite steady at around 3%. It shows some resilience of consumption. And for investment, FAI, fixed asset investment, seems to be negative in the second quarter of the year. But actually, for the whole year, FAI is negative. But when we look at the micro data, for example, stuff actually used for investment, like cements, like steel, like some petrochemical stuff, those stuff didn't really go negative. Our sense is that actual investment is stronger than the headline fixed asset investment would suggest. There are a lot of noises in that headline number. We shouldn't take it at face value. And if you look at credit growth, yes, household credit growth is weak. A lot of households are still deleveraging, but overall corporate credit growth is quite strong. That's why this year, in 2025, credit growth started to reaccelerate compared to 2024. That actually point to quite strong domestic demand conditions. Why the tariffs have a relatively limited impact on China's export? One reason is that the goods are really redirected through the global supply chains that Chinese companies and the global multinational companies this set up since 2018. Export to the US declined by somewhere around 30%, which is about, the tariff elasticity is about 1%. That's broadly in the range of estimate people have. But export to other regions, including ASEAN, Africa, emerging markets, also including Europe, are holding up quite well. And for the whole year, China's export grew at 6%. A lot of that goods eventually end up, by our estimation, end up in the US, just going through third countries. And a lot of the goods also, because of strong demand from certain regions like Africa. A lot of Chinese companies set up shops there, and that translates into a lot of demand for export. In any case, I think that was a surprise to many, but in respect, that can be explained by rerouting of exports and strong demand from certain part of the rest of the world. The most controversial part, I think, and debated part of Chinese economy is how well or how bad the real estate sector is doing. I think if you think it's bad, you find enough evidence for that. Prices are still declining, investment are declining at a very, very rapid pace still. But we also saw some green shoots to that sector. One thing is that you see that the developer defaults eased. There aren't many in 2025, and there are orderly debt restructuring happening to developers. It is not a panic type of credit squeeze anymore. And equity price of certain developers are actually performing quite well. The whole property sector, actually, their equity outperform the Chinese equity market. So that shows actually there are some renewed confidence in that sector. But in any case, this sector remains quite vulnerable, very weak, and the stabilization is not yet happening. We are hopeful that it will happen in 2026, but that's the big if. A final point on the resilience of Chinese economy is that price really started to stabilize and recover. Both CPI and PPI, they are very, very low for sure, but the reading start to improve a little bit. Core CPI now rising quite quickly, partly due to gold price and some of the trading programs. But even if you strip that, the core CPI, remaining core CPI is quite stable, showing that there is resilience in that. But again, if this were to continue, we believe that adequate policy, macro policy, still are warranted. Looking into 2026, we are quite positive on the outlook. We believe that external demand will remain strong, partly due to what's happening in Europe. I think Europe will spend quite a bit on military spending, but some of that will translate indirectly into demand for manufactured goods that eventually will come to China. I mean, U.S. demand for AI-related goods and grades-related goods will remain very, very strong, and we think the bilateral trade relationship between U.S. and China will be stable or even improving in 2026. So external demand will support export quite a bit in 2026. We also see policies being reasonably accommodative since this is the first year of the 15th five-year plan. So even though we won't have big stimulus in 2026, but the policies in general will be supportive. So we see growth. We see the government probably will target growth between 4.5 to 5%. We think that the economy probably will approach 5% for the whole year. But again, we think there are a few policies and risks I need to mention. We think the fiscal policy needs to remain very, very supportive. We think the fiscal expenditure has to grow more than nominal growth, more than 5% to support growth. We think there remains some room for monetary easing, though not much. We see currencies, the renminbi should strengthen. This is warranted by both the fundamentals, also the market sentiments. There are obviously downside risks to this outlook. The two biggest downside risks are one, if the property sector decline more than we expected, the economy will continue to face headwinds. Two, if policies are not sufficient or not delivered enough, that could also become a headwind. So we see quite a positive outlook for 2026, but depending on how policies are conducted. I'll stop here and hand over to Professor Huang.
Thank you, Guokai. And yes, I happily thanks for these very insightful points. We'll discuss at the end. That's the plan. And so we'll hand over to Professor Yiping.
Okay, thank you. And I thought Guokai did a fantastic job in discussing the near-term outlook and the challenges. What I like to do between Guokai and Alfred is to just spend a bit time talking about an issue that is both related to medium-term outlook, but also short-term performance, that is a rebalancing of the Chinese economy. Because I think normally we think rebalancing is a medium-term challenge, but now it has become a short-term constraint for economic growth. You probably all remember a month ago when there was a number showing that China's trade surplus during the first 11 months exceeded $1 trillion, and the final number for 2025 was actually 1.19 trillion. That's a big number, and I suspect that most people talking about, especially from outside of China, while people inside China sometimes look at the number and they say, well, we actually have a very resilient competitive export sector. But I suspect some people from outside of China look at this as a potential shock to the structure of the economy, jobs, income, and so on. So this is why I think this is something we needed to look at very closely. What my takeaway here is that rebalancing of the Chinese economy, especially if you look at the consumption share of GDP, investment share of GDP, and the current account balance as a share of GDP. During the last 1.5 decades, they were all moving in the right direction. So rebalancing is happening. But I guess it's not enough at this stage. So on the one hand, even though the shares are declining, but the absolute numbers still are very large. And that's why the impact on the rest, the potential adjustment cost imposed on the rest of the world is not necessarily lower. And that also poses a challenge for China. So for instance, if you look at our consumption share of GDP, according to the official number, it's slightly below 60%, and compared to an average of in the mid-70s for most emerging market economies. So rebalancing, well, the bottom was in 2010. Which was at around 47%. So from 47% to 57%, obviously shows that consumption is becoming more important. But the 57% is still relatively weak. And we have a typical term, a special term to characterize the Chinese macroeconomic situation, what we call strong supply side and weaker demand side. Which really means in most of the years during the last 4.5 decades, we always had the imbalance between supply and demand. But obviously, you would all agree that during the first couple of decades, that problem did not prevent China from growing rapidly. And our average annual growth for the last 4.5 decades of real GDP was still 8.9%, close to 9%. That's very impressive number. But I think the reason why we become more worried was because in the past, we were able to export out of our potential excess capacity problems. That is becoming more difficult. Number one, the international market is just less open and a lot more tariffs and non-tariff barriers compared to a couple of decades ago. And number two, equally important, China has become a large country economy, and that's why the reaction function from the international market to China's growing exports becomes very different. This is why I'm saying while rebalancing normally is a medium-term challenge, but it now becomes a more short-term constraint for Chinese growth. Because if we cannot export all of our excess capacity, you will see problems at home with regard to investment returns and the sustainability of economic growth. But as I said, rebalancing is already happening. Whether you look at the current account as a surplus, as a share of GDP, or consumption share of GDP, they all like moving in the right direction. But the point I mentioned earlier on, even though the shares are declining, but the absolute amount of the imbalance become larger because China becomes a much bigger country. And this is why I think the reactions from the international market are not really becoming mild, and the challenge and obviously is quite significant. That is also reflected in the inflation rates. Guokai just painted a relatively more modest or optimistic picture about rising core inflation and going forward, possibly continuous pickup. My overall take is if supply-demand imbalances continue, we might have to continue to suffer this at least the low inflation problem in the coming months. The good news is that the government already said that they're going to make appropriate increase in price levels as one of the main macroeconomic policy objectives. So they're paying a lot more attention to this indicator. The difficulty, I guess, is we don't exactly really know how to move up the price levels at the appropriate rate. My own suggestion probably would be we need a policy package, not just one policy. But that's related to, so excess capacity risk and low inflation risk. These are, I think, the two sides of the same coin, which requires a lot more policy action. The manufacturing sector is particularly serious in this regard, and we see some innovation, but excess capacity becomes a bigger issue. Here, I mean, we're talking about the evolution, and my sense is there are market factors contributing to this. Businesses all want to make investment in certain industries, promising industries, and that could lead to excess capacity like in any other market economy. But we also have a special government factor, especially the local government industrial policy contributing to dramatic rise of the capacity. And I think the second factor, local government related factor, a contribution to evolution is something that I would worry more, and I think we need to take some actions. So the government is looking at a new policy framework going forward over the next 5 years. And the term is called the dual circulation. And I think the key is to shift the growth model from the past input-driven and external market-driven growth model toward maybe a more innovation-driven and a domestic demand-driven model. The annual economic work conference also highlighted the importance of expanding domestic demand. And again, my sense is this is very important. But what really is the reason why expanding domestic demand becomes a short-term factor that would constrain a growth if we don't do well enough. And so I want to just to finish my discussion by saying that I think we need a policy package and some decisive policies in order to accelerate rebalance of the Chinese economy, although, as I said, it's already underway, but we needed to do a lot more. The first thing is we probably need to push ahead with market-oriented reform, and I do think we needed to regulate the local government behavior, especially the local government industrial policy, which is happening. But how quickly, how effective it is, I think we still needed to wait and see. The second thing, which is also very important, is, well, the core task really is to boost the consumption. And the government already devised the policies to the trade-ins for electronics and a number of products, which was useful in the short term, but it is not sustainable. I think we probably needed to do a lot more on household income and household confidence, especially related to Social Security fund, the balance sheet, and so on. So I think at the government level, lots of things needed to happen. But the other thing I think which is happening, and I hope we see more, is that the businesses have been very creative in developing new products, new businesses going forward. Today, I'm in Chengdu attending a forum organized by an IT company called Xiaohongshu. It's really a platform for exchange of consumers. But what we really find is on the platforms, they are finding lots of new products which did not really exist before, or new versions of the products that is evolved from the exchanges among consumers and the businesses and so on. We did also another study looking at the rapidly growing consumption goods, and a lot of them are related to the products related to the pets and the kids, and these are the sectors growing very, very rapidly. And obviously, overall, I think the service sector has a huge potential for both expanding consumption and also employment. So my final words is, number one, I think boosting domestic consumption has become a key condition for sustainability of growth, not only in the medium term, but also in the short term. The government needs to take a lot more decisive actions in terms of industrial policy, supporting income, and providing better social protection. But finally, I think the market is also working, and the businesses are trying very hard, and we're seeing very dynamic consumer space, especially in some of the new areas. I'll stop here, Moritz.
Wonderful. Thanks both for these very clear and insightful presentations. I must say, I have rarely had such a great combination of views on evolution and the challenges it also brings, combined with what's currently happening. Let me now hand over to Alfred to give his thoughts on the Chinese trajectory going forward.
Thank you very much, Moritz. What I'll try to do is bring it home. And I think the glue that connects the cyclical short-term part that Guokai discussed and the rebalancing that Huang Yiping talked about is truly the fiscal. In my view, it is mostly fiscal. It's the Achilles heel for what China needs to do to accomplish these multiple objectives. The most important message is it needs to have continued fiscal support to stabilize the economy, given the headwinds, especially from the property market. But in order to ultimately move toward rebalancing in a sustainable manner, it needs to boost domestic consumption, private consumption, and that needs a major fiscal reform. And as Huang Yiping indicated at the end, local governments in China have been carrying the baton as it relates to investments, including anti-cyclical fiscal policy in the past, and they are not on a sustainable foundation and ultimately need to have sustainable financing. And the answer to that is rebalancing the relationship between the central and the local government. So let me start out with the short term. And I think a lot of people ask the question, does China still have the fiscal space to do that is what is required to support the economy on the fiscal side? And the answer is yes. While deficits have gone up significantly here, the figure shows the official number of all the budgets combined for last year, just about 8% of GDP. So that is relatively high. If you look at debt levels, depending on whether you look at the central government, the general government, or even if you include off-balance sheet items, the fiscal space is more limited. But given China's overall public sector balance sheet, you can also look, of course, at assets, high savings rate, and a still relatively close capital account. China has what it requires to provide the additional support. As indicated, most recently in a high-level meeting in December, where basically the discussion is about the next year, so 2026, there was a clear statement that a more proactive fiscal policy stance is needed. So there is this recognition that Gurkhan and Yiping talked about. The key here then is not so much the constraints, it is ultimately the size and the timing of when this will be implemented. Historically speaking, unfortunately, China's fiscal has been very pro-cyclical. So the fiscal part came to the party relatively late. So the key here is enough support in a timely fashion to avoid somewhat of a slowdown. The second part, and that is this rebalancing, is that while China has the space to do the short-term part, in order to get toward a more private sector, consumption-driven growth model, households, companies have to have confidence in the future. And for that, you need a major fiscal reform. It is needed to instill confidence for households that their social safety nets are secure as it relates to spending on education and health, where the demand is, of course, increasing because of demographics that Huang Yiping also indicated. And that all puts pressure on the fiscal. So you need to have a major fiscal reform. Again, when you look at the highest level statements from China, the new 5-year plan that will be passed in March, or the third plenum from last year, all of them recognize the importance of including tax reforms. So the question again is not so much about the high-level commitment and the recognition that that is needed. It is moving from the aspirational to the design and ultimately implementation. So what is really required? And these numbers here are mind-boggling if you look at a country like China. When you look at China's fiscal, one thing that stands out is revenues. Now, when you do fiscal reform, obviously, you can always improve your spending, do a expenditure review, tax administration. All of that is important. But to really focus on what is needed, I just highlight a few facts. When you look at tax revenues, they have declined from 18.4% to 12.5% of GDP over the last couple of years. To put that in an international context, that is at the lower end of low-income countries. Now, if you want to convey to households that they don't have to worry about the future as it relates to health and education spending and social safety nets, these revenue to GDP ratios are completely inadequate. And on top of that, of course, you have additional demands for further spending on social services. So the main focus has to be on generating revenues by broadening the base. Now, there are many parts you can look at, again, just to prioritize where the focus ought to be and where the potential is very, very large. One of them is the personal income tax. In China, the focus is very much on indirect taxes. The personal income tax revenue collection as a share of GDP is 1.1%. Now, is that a lot or little? Well, let's look at the OECD average. That's about 8% of GDP. So you have a lot there. Now, is it because China doesn't have a progressive income tax? No, it is not. It actually has rates all the way up to 45%. But it is that only a small share of the population pays taxes, and those who pay at the lowest rate. To just give you a few numbers, it is only 25% of the workforce, or just about, that pays personal income tax. Of those who pay, 60% pay at the lowest rate, which is 3%. So there is a lot of room to broaden the tax base, maybe even with a possibility to reduce the marginal tax rate at the very top. So the first point to convert the aspirational into action is to look at the personal income tax. The next one, and that's the tax that collects the most revenues, is the VAT. But even in the case of the VAT, buoyancy has decreased, and the revenues collected from the VAT has come down by 3% of GDP. Again, why is that? And it's useful to look maybe at the European context as a reference. We have three rates in China, and it's 13, 9, and 6. If you look at the European average, we're looking at about 21, 22%. So very, very different. And because the economy is shifting from towards services, now a larger part is in the service sector, and that is at concessional rates, including the 6%. So at the end of the day, if one uses other countries, there is room to, first of all, converge the different rates and potentially also to increase them. Now, in all fairness, in December, a couple of weeks ago, China passed a VAT law. It's actually the first VAT law. And the question is, what has it done? It has done an important part. For the first time, you have basically now a legal framework, but it codifies the existing rates. So while it leads to transparency, certainty, which is all very good, but from a macro fiscal perspective, it hasn't really addressed the issue of generating more revenues. Now, there are, of course, other good candidates for potentially raising revenues, including a carbon tax, where China could benefit a lot, including state-owned enterprise to pay a higher share of dividends to the government, which would probably be beneficial on many dimensions, including creating a level playing field between private and state-owned enterprises. But again, if you really had to prioritize, number one, personal income, VAT, and again, maybe then the carbon tax. And the last point I wanted to make is coming back to this misalignment of spending and revenue relationships between the central and local government. Here, local governments face fundamentally financing difficulties. It has to do with two facts. One of the main revenue or receipts that local governments received before was by selling land. Now, that is not what it was in the past because of the developments in the property sector, and by issuing debt, but now we have higher debt levels. As a matter of fact, some of the local governments had debt levels that are very similar to what we saw in the European Union during the Greek crisis. And so the ability to rely on that going forward is not there anymore. What do you need to do? In part, to reallocate spending and revenue between the central and local governments. So more has to be done by the central government, putting local governments on a sound revenue footing. And since there is also still debt of local government financing vehicles that is basically off budget, you probably want to bring that on budget and ultimately consider even bringing local government debt on the balance sheet of the central government. Now, the big challenge for all of this is, and we in Europe know that very, very well, if you are at a point where the economy is a little bit under stress or still faces headwinds, to square the circle from, on the one hand, providing support in the short term, while at the same time putting in place the major fiscal reforms that you need to put the fiscal on a sustainable path in the future that helps you on the rebalancing side is not easy. And how do you do that? Through a clearly articulated plan. So you might not have to implement all of the elements at T0, but to communicate what you intend to do in the future, and that gives you the credibility that you need. I'll stop here.
Thank you, Alfred. Thank you, all three again. So let me kick off the discussion. I think we've learned a lot, and a lot of the points are overlapping and mutually complementary. So let me start from like a perspective of a European scholar. So on the anti-involution theme, clearly there is lots of losers in an involutionary economy, but also people who benefit, cheaper, better quality goods, life conveniences. It seems to me that we've heard, maybe not the term involution might be new, but like the sort of rebalancing idea, it's been a constant theme over, I don't know, dare I say the last decade or so. Yet it seems that very little has happened. Trade surpluses have crept up again. Global imbalances are back. So, I mean, in addition to the government's anti-involution campaign, what else is needed to change the business and social culture that seems to be at the root of the involution of that of that growth model that we've all become used to? So maybe I'll open this question and give in sort of another question from the chat is the demographic issue. How do we think about the transition to a more consumption-led economy against the backdrop of the demographic problem? So I don't know. Should we take these questions maybe in the same order as we had presenters, so Guokai starting, and then we'll move on.
Okay.
Feel free to jump in, obviously. Yeah.
Yeah.
Yiping, how about you answer it?
You go first. Do you want to address the involution?
I think a lot of I'll talk about more short-term issue regarding involution. A lot of the involution issue, I think, happened after China's housing market collapsed. Then there's need to boost investment, and the investment has nowhere to go but move into the manufacturing sector. That's why you see quite a dramatic buildup of capacity after 2021. This process, I think, essentially stopped after 2024. So going forward, I think we're going to have probably a less issue since due to this collapse of housing market and have to compensate for manufacturing investment. I only answer the short-term part. I guess the more structural part probably I need to give it to Professor Huang. He probably have more to add.
So I will respond briefly, just continuing what Guokai has said. I think this involution issue we need to look at from different angles. Moritz, you hinted like maybe there is a cultural problem with the business activity. I'm not too worried about the businesses competing with each other. You might use the term excessively, and I think that's the way you compete with each other. You improve efficiency, you grow. And the other thing you also find is when excess capacity really becomes an issue and led to losses, the corporate sector adjusts, and like we're seeing also in the sectors like the new energy sectors as well. The problem, my worry about the evolution, number one, as I said, if you have at the macro level an imbalance between supply and demand, and you end up with some a terrible result. That's why I think rebalancing is really becoming very important. But the more fundamental question here, I think, is more related to government behavior. Is if this evolution is mainly contributed by government behavior and local government and SOEs, like if they have access capacity, but they don't exit. And I think the consequences could be more serious. So this is why I said earlier on, maybe the way to look at this is move forward with market-oriented reform. That's my take. If the government controls less resources and also makes less direct intervention in terms of industrial policy. I don't oppose to industrial policy, but if industrial policy only lead to expansion of the production capacity without necessarily improve efficiency or raise the technology level, then they're not very useful. So I think my focus is more on the government behavior. Otherwise, I think the market and the corporate sector would probably adjust. On the question of aging, and obviously it would have an impact on consumption demand over time. But in the short term, it shouldn't, because there are lots of demand, the potential demand there, but they're not coming out. For instance, when people becoming older, and some of my colleagues actually did some analysis, and they find the consumption demand is the strongest for these what they call young old people, like immediately after retirement, within the first 10 years. You have lots of demand, and you suddenly find you have money, you have time, and you have the energy to enjoy lots of things. And also, I think you could look at the medical care, elderly care, and so on, even education, training, traveling, and so on. So I think I would not be too worried in the near term if we can get the policy environment and the institutions right, and obviously income and confidence. But over the longer term, this probably would be an issue. That's my take.
Maybe I could just sort of like echo, Huang Yiping, what you said on the involution side to emphasize the structural challenge that exists. The system is very good at incentivizing new policies, industrial policy by getting new players in credit allocation and so on and so forth. But where it is very, very weak is by facilitating the exit. As a matter of fact, there is a resistance because it can lead to social instability. And so you have the tendency, and I think this goes beyond the cyclical part, this is a structural issue, that currently the frameworks that are in place to allow for an orderly exit leads to have too many companies in a particular sectors that were incentivized to come in, but then ultimately not exiting. So I think to put more emphasis on strengthening, on the one hand, resolution frameworks, bankruptcy, not only the law, but also ultimately the capacity and the true implementation and the incentive structures to do that, I think will be critically important to allow the market to do exactly what Huang Yiping has been talking about. And then related to that, and we have that, of course, in other countries, especially in Europe, to put in place safety mechanisms that allow the exit without creating too much social concerns.
Great, thank you all three. Let me maybe I have I think covered the questions in the chat quite well. Let me maybe from my side as a final question to all of you, bring in something that plays a big role for people outside of China, namely developments on the external side. We've seen a quite pronounced depreciation of the exchange rate on a trade-weighted basis against, I guess, all odds of the strength of the Chinese economy. And we've also seen an explosion again of the trade surplus and the associated accumulation of reserves in in the world economy that has become quite uncertain. So, what's your take on how the external side, especially foreign exchange policy, will evolve from here? Because it's very hard. Let me say it, it's very hard to make the case to a European audience that what China needed over the last 2 years is a depreciation against the euro of 20% or so.
Let me give you my take, Moritz. This is a good question. I think if you look at what happened to China's foreign exchange rate, for the better part of the past 2, 3 years, actually the PBOC is defending the currency from depreciating more against particularly dollar. Uh, so it's not like China is intentionally weakening the currency. It's the trade, it's the tariff, it's the weakening of domestic economy that make the sentiment really weak. That led to quite weak currency. That trend has turned around, I think, since the Q4 2025, the last quarter of last year. So the currency, I think, strengthened up around 4% versus dollar in very short time period. My sense is that the central bank will continue to allow the currency to move up if market push the currency up. But they're probably going to moderate the appreciation a little bit if it's moving too fast. So they won't let the currency move too quickly. That's my sense. I think that my prediction for the year for this year is that renminbi probably will appreciate nominally 3, 4, 5%, and in real terms probably 1 to 2%, so that it didn't really go all the way back to where it was, but it's going to move towards the right direction. That's my take.
Great. Thank you. Thank you so much. Let me hand back to Alfred maybe for some closing words. Or I mean, Professor, yeah, Yiping, you want
No,
to
I don't.
come
No,
in?
I don't.
Please do.
Yeah.
Please do. By all means, please do.
Yeah, on again, on even on the external side, just to echo, it is of course China's own domestic consumption that continues to be very weak. The moment that improves, it will at the margin improve at least part of the trade story. Maybe just to kind of thank everybody for joining us today. I think the idea that we have with Moritz's, Huang Yiping and Kai's consent to do this on a regular basis, maybe in the middle of the year again, to review where we are and maybe see whether our own predictions were right or not. It is truly an effort to share, data and information on Europe and China, and at the margin facilitate the dialogue to ultimately put in place the policies to make this an equilibrium and sustainable. So with that, maybe thank you very much to all of you, and for all who joined us online. I think we had fantastic representation both from Europe and from Asia, and I think that's exactly what we wanted to accomplish. Moritz?
Very happy to see for the next edition. Thanks for organizing this. It was a great pleasure. Thanks, Guokai, Wanikme.
Thank you.
Wonderful.
See you next time.
Bye bye. Yes, see you
Yeah.
soon. Hope. Bye bye.
Bye.